welcome. My name is Dave Kopelak. I'm a business lawyer at Emerge Law Group. This is our fourth installment of our deep dive series into Measure 109. Thanks for coming. Today's main topic is entity organizations and taxes. I think we're going to follow the general outline that we've been doing in the first three webinars, where we'll talk about our main topic for a while, try to get that over in fairly short order, maybe 20-30 minutes, and then open it up for a Q&A session, discussions, and so forth. I would like to introduce my colleague, Sean Clancy. Sean's a business and intellectual property attorney. He's going to be emceeing the event today and sort of following any questions you might have in the chat room, and given the kind of the ground rules of the whole thing. And then once I'm done with the presentation, like I said, we'll open it up for Q&A. So Sean, do you want to give your intro spiel?
Sounds good. Thanks, Dave. Hello, everybody. Nice to see you all filing in. Looking forward to get started. So some housekeeping items with our Zoom format here before we dive in. So we're recording because we're going to probably post this presentation to our website, our YouTube channel, but we actually don't intend to use the audio or video from the Q&A session. So don't feel shy about asking questions or appearing during the Q&A session. Like with our other deep dives, the Q&A is going to come at the end of the initial presentation. The way we're going to do questions, because we have so many people joining, is ask that people either submit the question in the chat box or state in the chat box that you have a question, or use the little raise hand function, or if you appear on video and just raise your hand. I'll be watching all of those to try to play traffic cop to avoid too much crosstalk. Just be mindful of any amount of time you're taking up as we call on you, because we want to get to as many people as possible. We haven't had to use the mute function, but we do have that ability if anybody's being disruptive or having a conversation and forgets to mute themselves. So just please be mindful of that. We've allocated 2 hours for this event today. Hopefully most of that will be Q&A and discussion. Yeah, like I said, I'll be watching the questions and comments in the chat box, so feel free to be active there. This probably goes without saying, but of course, we're not acting as anybody's attorney or giving any legal advice during this presentation. So please don't ask fact-specific questions for your situation. We're merely providing information for educational purposes. Yeah, with that, I'll kick it back to you, Dave, to get started with the presentation.
All right, thanks, Sean. I should say that my tax colleague, Bernard Chamberlain, is here too. And he may, if I get stuck on something, Bernard can come in and help me out. Okay, so like I said, main topic today, entity organizations and taxes. I'm going to flip through this slideshow, and we'll eventually post this slideshow too. But the main topics I'd like to just touch on are choices. Some of this stuff is fairly basic entity organization discussions, but I'm figuring the audience might be made up of folks with various experience in this. I'm going to just kind of lay it out here. A lot of it might be basic, but I'll try to go through the relatively straightforward stuff quickly. But of course, during the Q&A session, anybody could ask anything. So I'll touch on choice of entity briefly, different tax classifications for different entities. Internal Revenue Code Section 280E. Anybody in the cannabis industry knows what this is, but this might be new to some folks in the psychedelics industry. And we can talk about maybe some various organizational structures. And then also, as most of you know, Oregon Measure 109 does impose some residency requirements for licensees. So we'll touch on that. Choices of entity. The Measure 109 does not basically allows any entity under state law to be a licensee. So that could be a corporation, LLC, limited partnerships. You don't see too many of those these days, but theoretically you could have one, or nonprofit corporations. Theoretically too, a business could be a sole proprietorship or a general partnership, but those are frowned upon, especially for liability purposes. You would never want to be a general partnership or a sole proprietor. So usually, it's going to be one of these four entities. Now, the choice of entity and how an entity is classified for tax purposes is usually a decision made in conjunction with the attorney and the client's CPA and the client. I would prefer not to make that decision myself. I would prefer to sort of have it be a collaborative thing with the client's CPA, because the CPA person will be crunching numbers and is probably a little closer to things like that. So from a trafficking business, from an ordinary business, I, as a business attorney, usually don't care too much whether something's a C corporation or LLC. From a liability perspective, all of these entities provide you with state law, the same sort of protection for owners. And really, the choice of entity is oftentimes, not solely, but oftentimes driven by tax decisions and forecasts by the CPA. Now, there are a lot of different ways to go here, but there's I would say two general classifications that are relevant for Measure 109 purposes. There is C corporation taxation, which is essentially two levels of taxation. So your entity, your corporation, pays income tax on the corporation's earnings. Now you have shareholders. Now the shareholders pay a second level of income tax on any distributions, like dividends, that they receive from the corporation. So this is what folks usually refer to as double taxation, which is usually considered kind of a bad thing in a way, but the tax liability for the corporation is contained in the corporation. So this is why I have here, shareholders cannot lose more than they invest. That's a simplistic statement, and there are definitely exceptions to that, and even in the corporate world, where a plaintiff could pierce the corporate veil and get through to the shareholders. But generally speaking, from a taxation standpoint, if you're a C corporation, that none of the tax liability, none of the income tax liability will flow through to the shareholders. So that's why I say shareholders cannot lose more than they invest. If I invest $100,000 into a C corporation, and the worst thing that could happen is a C corporation goes bankrupt and I lose my $100,000, but I'm not going to have any tax liability on top of that. And likewise, I will never be taxed on funds that I don't actually receive. If the corporation declares a distribution and I get money, I will get taxed on the money I receive, but I'm not going to get taxed on funds I don't receive. Contrast that with pass-through taxation. So the upside here is that you have one level of tax. You don't have the corporate level tax and then the shareholder tax. The entity itself does not pay any income tax. All of the income tax that was earned by all of the income that was earned by the entity gets passed through to the entity's owners on a pro rata basis based on their share ownership or other, their ownership interests. And the owners are directly responsible to the IRS for paying income tax on the entity's earnings. And this is the case whether or not the entity declares a dividend and makes distributions to the owners. So that sounds scary, but usually in businesses that don't have anything to do with a controlled substance, we have provisions in our various entity agreements where we say on a periodic basis, the entity is required to make distributions to the owners, at least in an amount sufficient for them to be able to pay the taxes on the earnings that are passed through to them. So, and if you are, in a normal industry, that's usually a fairly safe thing, and most small businesses are pass-through taxation, either as S corporations or LLCs. But theoretically, you can lose more than you invest. If you taken my numbers. If you invest $100,000 into a pass-through entity, and for some reason the entity, the entity has no money to distribute to you, and in fact becomes insolvent, but based on certain timings of taxable years, there was earnings in a taxable year, and they don't have the money to distribute to you so you can pay your taxes, you're going to get hit with those earnings on your personal tax return and be personally responsible for those taxes. And following through on that, you could certainly be taxed on earnings that you don't receive. Hey, the entity made $1,000. You're responsible for your pro rata share for that. And you would say, well, I never got the money though. And that's, the IRS doesn't care. You're responsible. That's the nature of kind of a pass-through. And that's going to become really relevant here in a minute with 280E. Here are the various entities, and this is what we kind of do on the front end all the time. We've got certain defaults. If you're a corporation, you're by default a C corporation. You can elect to become an S corporation. There's certain limitations on that and rules, but you can elect to become a pass-through entity. LLCs have different defaults. If you're a multiple member LLC, the default is partnership taxation, single member, disregarded entity. Those are all pass-through entities, but LLCs can also elect to be taxed as a corporation, either a C or S. Nonprofit corporations are locked in as C corporations. So, what you're going to be, a corporation, LLC, and how you're going to be taxed is always a discussion on the front end. Okay, now here is a really bad provision. So this is section 280E of the Internal Revenue Code. Everybody in the cannabis business knows what this is, and it will apply to the psilocybin business under Measure 109. In effect, it says no deduction or credit. So no deductions, think about this, no deductions are allowed if you are carrying on a trade or business that consists of trafficking in a federally controlled substance. Under Schedule 1 or 2, psilocybin is a Schedule 1 controlled substance. Consequently, psilocybin businesses are trafficking in a controlled substance and subject to 280E. Now, no tax deduction sounds really scary, but it's not that bad, although it is bad. Technically speaking, your gross income can be adjusted downward by something called cost of goods sold. And then you arrive at your taxable income. So you can think of that as a deduction. Technically, it's not a deduction. Technically, it's an adjustment to gross income. But the net result is, you can think of it as your gross income minus your cost of goods sold, your COGS, equals your taxable income. Now, what are COGS, and why aren't we just talking about normal deductions like every other business? Well, we're not talking about normal deductions for every other business because of 280E. But under 280E, you can, again, subtract out your cost of goods sold. What are they? Goods is sort of the operative word there. Cost of goods sold are your direct costs of acquiring or manufacturing merchandise, things, goods that you sell. Expenses unrelated to that are not COGS and therefore essentially not deductible. And I say no goods, meaning no merchandise, means no cost of goods sold. Here's an example for psilocybin manufacturers, cultivators, processors. What costs are directly related to the production of your products? Well, raw materials, supplies, production equipment, certain things like that. What is not COGS? Administrative overhead, office supplies, legal, accounting, travel expenses, sales, marketing, all of that is not deductible at all. And that's bad news. What about salaries or rent or utilities? This is where it gets a little strange. These expenses, which would ordinarily, for any other business, be deductible 100%, have to be allocated. So your CPA or bookkeeper is going to look. So here's an example. You pay X dollars per month rent for your psilocybin production facility. What percentage of square footage of your premises is directly related to the production of psilocybin products? Do you have an office area in your facility? Well, that's probably not related to production. That's where you sit and talk on the phone or on your computer or do office work. Is there a bathroom? Is there a break room for employees? Is there other space that's not being utilized for production? So what CPAs would do is they would say, okay, our rent is X dollars per month. Well, we can draw lines around the floor plan, and we can say this percentage of the rent is cost of goods sold, and that's deductible, and the other percentage is not deductible. So you can see how that could get a little interesting, and you can see how basically it's not good. Same with salaries. What are your employee costs? What does a particular individual do? If 100% of their time is spent on the production of the psilocybin products, then you can deduct their entire salary. But if somebody is doing some marketing for you, or if they're multitasking and they're doing several things, then you may not be able to deduct all of their salaries. They spend X% of the time on production and Y% of the time doing other stuff. Well, you can only deduct X% of their time for COGS. So this is how complicated, or an added complexity, that every other business in the world who is not trafficking does not have. Now, here's where this is all a numbers game, but here's the problems. Your actual expenses are always going to be greater than your COGS. I mean, you're never going to be able to deduct 100% of your expenses, because there will always be expenses that do not qualify as cost of goods sold. Follow that logic through, and your taxable income is always going to be greater than your actual profits. You're paying taxes on profits that you really didn't earn. There's going to be some delta where you have what we just say is phantom profits. You could be taxed for money, again, that you don't earn. And in a nightmare situation, you've actually lost money. I mean, consider this. Your business is not profitable. You are losing money, but because you can't deduct all of your COGS, the IRS, on paper, you're making money. So to add insult to injury, you're paying taxes on earnings when you didn't even have profits in the first place. So this is where it can get really bad. And you can see, if you have pass-through taxation, how that could affect the owners. If you're not making money, but the IRS says you're making money, and you have to pay taxes on the earnings that you didn't really earn, and the owners are personally responsible for those taxes, that's when things can get pretty ugly. Now, for psilocybin manufacturers, it's not, 280E is not good for anybody, but it's usually not that bad, because most of your expenses, you could say, are directly related to the production of products. In the cannabis industry, again, the cannabis industry have been dealing with this for years and years, and most cannabis growers and most cannabis processors just deal with 280E, and they can, deduct some, I don't want to put a number on it, but let's say it's just broadly between 60 and 90% of their expenses end up being deductible. And so it's not good, but they can survive. Cannabis retailers have always had a harder time, because their cost of goods sold are only the cost of the products that they've purchased from the producers or the processors. So, they're buying goods from a supplier. A retailer is just a reseller, right? So you're buying goods from a a supplier, you're sticking it on the shelf, and that's your cost of goods sold. There are ways to eke out a few more cost of goods sold as a retailer, but by and large, most of your labor is not going to be at all, or most of your rent is not going to be a deductible. So retailers get hit in the cannabis world. Retailers get hit by 280E much worse than producers or processors. Now let me go back to the slide here. So psilocybin manufacturers, I think, are going to be analogous to cannabis growers, and they're going to get hit, but they'll survive. Service center operators, I think, are going to have a real problem, or a real potential problem, if we don't come up with some pretty nifty solutions. I mentioned a cannabis retailer buying goods, but now Measure 109 has something that the cannabis industry doesn't have. It has services. Services are not goods, and there are $0 of cost of goods sold involved with the providing of services. Now, as we all envision Measure 109, a service center will be selling a product to a client and will be providing services to a client. Now, from what I've heard and from what I expect, the services are going to, the price of the services is going to drastically be higher than the price of the product. Now, remember, there's a sales tax in Measure 109, and the sales tax is on the product and not the services. So every service center will, just by virtue of sales tax, will have, I imagine, 2 line items on an invoice, if you will, and the client will pay X dollars for the product and Y dollars for the services. And again, I think the price of this product is going to be relatively small, and the price of the services is going to be relatively large. But the service center's COGS are going to be almost nothing. It's going to be the wholesale cost they paid for the product. And what are a service center's expenses? Well, it's potentially a lot of real estate and rent. It's the services, or the salaries or expenses they have to pay to the facilitators, who are all doing services, right? The facilitators, so all of the facilitators' expenses are potentially not, well, they're not COGS, they're not cost of goods sold at all. And so I'm wondering how service centers are going to deal with 280E. And I think this is where I think the problem could get very serious. For facilitators, that's for service centers. For facilitators can be employees of service centers, or they can be independent contractors. They can be freelance independent contractors, or I suppose facilitators could get to, 2 or more facilitators could get together and form their own company, form their own facilitation company. Now, if you're a facilitator who just happens to be an employee of a service center, you don't have to worry about 280E at all, because you're just an employee and you're not conducting a trade or business. So 280E doesn't apply to you or your salary. But for facilitators who have their own businesses, freelancers, I don't see how they have any COGS at all. They're not selling any goods. They're not buying any goods. They don't have any inventory, and so they have no COGS, which could be a problem. So then we have to go back and try to figure things out. Is a facilitator trafficking in a controlled substance? Is there a way for folks to avoid 280E? 280E is what it is, but is there a way to sort of fashion things around it? What does trafficking mean? Well, there's a handful of cases in the cannabis industry that have dealt with 280E. I think I haven't been keeping up on every case. Bernard can correct me if I'm wrong, but I think of the various cases that have dealt with 280E over the last several years, I think there's been one that was favorable to the taxpayer, and every other case came out in favor of the IRS. So it's a bit of a, so far the batting average for the taxpayer hasn't been very good. But again, psilocybin Measure 109 being so different than having a service component to it, which is so different than cannabis, raises some very interesting questions. So are facilitators who have their own businesses, are they trafficking? Well, if they never buy or sell psilocybin products, if they never transport it, if they never take possession of it, and it might be better for tax purposes, if not for traditional purposes, for tax purposes, if they never handle it or touch it. One, I think, could make an argument that they're not trafficking and they're not subject to 288. So that's, but is that a slam dunk answer? I don't think so. Now, service centers will definitely be trafficking, and they are, by the statute, by Measure 109, they are selling a psilocybin product to a client. So that's the transaction. They're buying psilocybin, they're reselling psilocybin. Service centers will definitely be trafficking. But, and here I think is the big one for service centers, is it possible to structure an arrangement so that the sale of products, on the one hand, can be bifurcated from the provision of services on the other hand? And can we say somehow that the sale of the product is trafficking? Let's put it this way: the purchase of the product from the manufacturer, the resale of the product to the client, the delivery of the product to the client, and now I'm envisioning kind of the initial consumption portion of the administration session and the client's consumption of the product. That sort of, all of that, it would seem to me to be trafficking for sure. But is anything else trafficking? Is the preparation session that occurs before anyone even touches psilocybin, is that trafficking? Could we possibly argue that the post-consumption portion of the administration session, which I imagine from a time perspective is going to be most of the session, sort of assuming medium or macro doses at this point. I'm not really getting into microdosing here, but what would normally be considered a macro administration session, one would think that could go on for 4, 6, or 8 hours, that obviously the consumption portion of that is going to be a fraction of the whole session. And then the post-consumption or post-administration session, integration session, is that trafficking? I mean, that would seem, the preparation session is a conversation that happens where a client may not ever get to the administration stage. So I think there's a pretty good argument that that's not trafficking, or that portion of it's not trafficking. The integration session is an optional post-administration session conversation. I think a decent argument could be made that that's not trafficking. Any other bells and whistles and services outside the administration session. But I think the big question there is the second bullet under not trafficking, is the post-consumption portion of the administration sessions. Could something be concocted to make a straight-faced argument to the IRS, if and when they ever come knocking, that that portion of it was not trafficking? So in speaking with a few folks and just sort of doing some pretty early brainstorming here, and I put just brainstorming with an exclamation point, so that nobody does this on their own in reliance on this slide and then comes back a year from now and or 2 years from now or 3 years from now and complains about this. This is just a complete bare bones idea to get the ball rolling on how we as an industry should think about how we do this. But I thought that one sort of possibility here would be if you had a service center with 2 co-licensees of record. In the cannabis industry, the Oregon Liquor Cannabis Commission allows there to be co-licensees. So under one license, 2 separate entities can be co-licensees under a license. That's not spelled out in Measure 109, but I would say it wasn't spelled out in Measure 91 for cannabis, but I would say that hopefully the OHA will come up with a rule that says that that's permissible. And if it is, you could say, you could theoretically have two entities that are co-licensees, entity A and B. You have a licensed premises, and from the OHA's perspective, the licensed premises is where any portion of the administration session is going to take place. But if think about a licensed premises that is itself divided into two areas. One area where the products are, where the products are stored, where the products are delivered to the client at the beginning of the administration session, and where the product is consumed by the client. And then envision, and maybe that's a smaller area from a square footage perspective than the whole premises. And then you have another area where the client, after consuming the product, kind of walks over and leaves the ceremony room, or however it's labeled, and goes to another area where the post-consumption, the rest of the post-consumption administration session continues for potentially hours and hours. You could structure it so that entity A leases, entity A, which is the trafficking entity, leases the area A, and entity B leases area B, which is arguably the non-trafficking area. Now here's where, any variety of, sometimes when you're doing planning like this, you're planning in anticipation of somebody, of the IRS disagreeing with your position. And so you're trying to build arguments in advance if the IRS audits. I mean, you're going to take a position on a tax return, and you're going to, if you're so bold to ever have a solution like this, and you're going to say, okay, here's our situation. We've got two entities. Entity A is trafficking. Entity B is not trafficking. We're not going to apply 288. You're going to do your thing on your tax returns. The IRS is either going to let that sail through, or a year or two or three later, they'll come knocking and say, you're under audit, and they'll look at everything, and they will examine everything, and they'll ask a whole bunch of questions, and you'll have to provide answers. And this is what you're trying to do. You're trying to sort of set the stage so that you have a first line or a second line or a third line of defense, and to make your arguments. And so I'm wondering whether, and some of this might seem overboard. And again, you can do some things and not other things, but if you were going to kind of try to get as maybe conservative, I should say this whole thing is probably not conservative, but within it, you can be more conservative or not. But if a client consumes the product in area A, under what I wrote here, under the supervision of a consumption facilitator who works for entity A. So you've got this limited thing going on for entity A in area A, and there's trafficking going on. And that facilitator is there for a short period of time. The client walks over to area B and goes on with the rest of the administration session, and with perhaps a different facilitator who works for entity B. And the client is now, I see three invoices here, right? I see entity A having an invoice for the product. How much does the product cost? That's what the sales tax is on. How much are the services that entity A is providing? Probably pretty limited, because you're talking about a consumption facilitator who's sitting there for a relatively short period of time, watching or setting a table or doing whatever is being done, and watching the consumption take place, because the consumption is part of the administration session. So the statute and the rules will require a facilitator to be there. But one might ask, is how important is that, or how long will that take, or that could, what's really happening during that consumption portion may not be that important. And so you could sort of have this like consumption facilitator who's working for the trafficking entity, just sort of be there, watch the consumption, client moves over, different facilitator, different company, different premises, different portion of the licensed premises, and everything else happens. Now, this is just an idea. Will it work? Who knows? I talked to a CPA the other day who thought it would not work. You know, their entity B would arguably not have any business at all, but for entity A, like entity B's existence doesn't even make sense without entity A, and the IRS would just merge them together and view them as one business. The CPA I was speaking with suggested that if entity B had other stuff going on in the licensed premises that could be perhaps besides being totally reliant on administration sessions following a consumption, if there was anything else going on in the premises, that might bolster the argument and make it look a little better. Okay, here's another one. You have one licensee, just like most folks have usually envisioned. One owner of a service center. The service center leases the entire premises, but still divides up the premises into two sections. Now, this is almost an outsourcing business model where the service center obviously has to buy the product and resell the product to the client. And you could still have a sort of this consumption thing happen with by the entity in area A, but that's where the trafficking is happening for the licensee. And then I put "we're done" here. Could the licensee just say, "Hey, we're not providing services at all for the rest of it. Like, we did our job." Some facilitation company is going to pick it up from here, and we're just letting them use our space. They're coming in, and this wouldn't be a lease. This would, I suppose, be what we usually call a space use agreement. It's something short of a lease. I mean, we do this for, oftentimes for someone owns real property and somebody's for events or for one thing or another. Somebody's coming on somebody's real property for a limited period of time to do a limited thing, and then they're off the property. We generally come up with agreements that don't create a leasehold interest from a legal perspective. So a psilocybin facilitation company, a separate company, could come on board and basically pick up the administration session in the middle of the administration session. And the company B, or I should say the third-party facilitator business, would have its own deal with the client and charge for their services. And the facilitation company would just pay a use fee, a space use fee under the space use agreement. And the issue there would be whether the service center could say, "Hey, we're not trafficking. We're not even providing these services. So there's no trafficking there. Our whole deal here was to just do the consumption portion, and in the other half of the administration session, you're almost just a landlord in a way." And then the facilitator might get, they could argue, well, we're just coming in, after the fact. We're coming in after the consumption and all the trafficking has taken place, and we're just following up on that. So that's more like the administration session. I'm sorry, that's more like the preparation session or the integration session. We're just kind of coming in after the fact, and we're not trafficking. So these are just a couple of instances that might work. I think some of the challenges there are, how much are you going to contort yourself into a pretzel to get this protection, and how is that going to affect your business deal with your partners and your investors? And what were your business plans to hire service center or hire facilitators, or to contract out with them? And as a facilitator, did you think about this from an independent contractor perspective or from a business owner perspective? So I think and then you get into choice of entity on top of all that, and it's really interesting. But I think that oh, and I should say that I think I see a lot of C corporations here, right? Anyone who's pushing the envelope with, and I don't say pushing the envelope in a bad way, but anyone who's taking a position that might have, where 280E is a potential problem, would, playing it safe would be to have a C corporation. So there's no tax, no pass-through taxation, and any liabilities contained to the entity itself. That'd be the worst case that could happen in. In the cannabis industry, we did have cases where I had one client who formed a C corporation. Their dispensary owes the IRS over $500,000 in back taxes. They can't pay it. And so the store can just close the store, go under, and that's the worst thing that could happen, but the IRS can never get through to the owners. We had another case where a dispensary, we didn't do this ourselves, but it came to us where a dispensary was in a similar situation where they had pass-through taxation. Bad mistake. Numbers played out wrong, and the owners not only lost their money from the business, but now they have a big old tax liability to the IRS on money they never received. So you can imagine how happy those folks are. But all of this sort of thinking got me thinking that when the OHA comes up with its rules for administration sessions, technical licensing rules, things of that sort, that we may want to think of this ahead of time. And I don't think any of these rules affect safety or anything like that, but I think that it might be in everybody's interest if the OHA and the industry would allow, the rules were such that companies and licensees could have these various business arrangements without running afoul of rules. So for example, I think I would hope the OHA and the industry could sort of figure this out, that, for example, allowing 2 or more entities to be co-licensees of record is not a bad thing. Like, that should maybe be laid out in the rules. Allowing 2 or more separate individual facilitators to be the facilitators at various stages of the services, whether it's preparation, integration, administration. Within an administration session, the rules say that there has to be a facilitator there to do all this, but does it have to be the same individual? And can facilitators in a way almost switch out at various stages of the process? Allow business arrangements where independent contractor facilitators can provide psilocybin services rather than the service centers themselves. That was sort of a brainstorming thing, number B there. Oh, and then this is sort of picking up on what the CPA I spoke with the other day said. In the cannabis industry, there's detailed rules about when a member of the public or when somebody else can go into a licensed premises. If it's a retail store, of course, customers come in all the time, but customers cannot go behind the counter into the back room. And when you have a production facility or a processing facility, obviously you don't have customers just walking in all day, and there's rules about who can access those premises. But I'm wondering whether for service centers, whether the OHA could come up with a rule that says, here's a licensed premises, and there's a portion of a licensed premises that's off limits to everybody because that's where the storage of the psilocybin products is taking place. That's area A in our examples. But when there's no administration sessions going on, could area B be used for other things? That might help things out from a tax perspective. And I think, there's practicum possibilities here where service centers could, when they're not conducting administration sessions, could hold practicum training for students. And there's many other things that could go on. So obviously the size of the service center comes into play here. If your entire service center is a little small, tiny office room, your choices are a little bit limited. But if your service center is sort of some larger, more sprawling piece of real estate, I think there's a lot of possibilities there where you could have other lines of business happening and other people accessing that premises when sessions are not taking place. So, and I'm sure there's others, but I think it's what I'd like to make sure is that when the rules are drafted, that the next set of rules are drafted, that we don't find ourselves forming companies at the last minute and then realizing that the CPAs and tax planners are coming up with really nifty ideas to help out the industry from a 280E perspective, but we can't do it because the rules don't permit it. So I think it's, you know, time for us to all think about what possible solutions we might have here, and whether those solutions would involve some of these kind of, I would say, more technical rulemaking decisions. Yeah, I think I jumped ahead to this one, but you know, if 280E is a potentially significant problem, C corporation tax classification is the safest choice. You know, nothing gets through to your personal tax returns, and you're kind of playing it safe. And the corporation will end up paying taxes on phantom profits, but you won't as an owner. And I suspect, you know, the IRS sometimes targets particular industries that they think might be subject to areas of abuse or incorrect tax position. So just like in the cannabis industry, we kind of expected the IRS to eventually, I don't think we've seen, you know, not every cannabis company has been audited, but a lot have. And so I suspect that, you know, this is a brand new industry and we might expect some audits a couple of years after things get going. And so it's, you know, that's coming for sure. There you go. I have mentioned in the cannabis space, I have seen several disasters, several real disasters. And so I think that it makes sense here. And I think the 280E situation here is more complicated because of the services element of this, and because services are not cost of goods sold, that it's trickier here. It's potentially more disastrous and it's trickier. And so I think that a lot of thought has to get put into this on the front end. Okay, that's the 280E nightmare talk. Really quickly, residency, Measure 109 has residency requirements. Here are the rules. If you're a legal entity, which everybody will be for manufacturers or service centers, that you have to be majority owned by Oregon residents. Facilitators or individuals, they have to be Oregon residents. The statute says resident means a resident for the 2 or more years. The OHA has not come up with rules yet on what constitutes proof of residency, but under the former cannabis rule, back in the very early days of cannabis, for about a brief period of time, we had residency requirements, and then the legislature stepped in and repealed them. But there were, for a moment, OLCC rules that said this: Oregon full-year resident tax returns for the last 2 years, or utility bills, rental receipts, mortgage statements, and the like, that contain, you know, going back 2 years, that contain the name and address of the particular individual. So in all likelihood, something similar to that will be under the OHA's rules. And under the statute, Measure 109, the residency requirements expire on January 1st, 2025. So really, we're talking 2023 and 2024. Now, just a note on this. We've definitely had calls from out-of-state clients who intend to sort of get in the industry, and I at some point say, oh, you know, where do you live? Oh, I live in somewhere else. I don't live in Oregon. And I then give them the residency talk and say, yeah, you need to kind of partner up with one or more Oregon residents. And of course, you know, just to be upfront about it, you know, in the cannabis industry, we do this for residency in other states and for other social equity purposes and what have you. But of course, we get inquiries like, well, can I just stick somebody on a piece of paper and tell the regulatory agency this is the deal, but like it not really be the deal? And I say, no, I'm an attorney, I can't do that. And they said, I had one person say, well, can I give somebody can we have two classes of stock, and can I give the resident a class of stock that never gets any money and never votes and has no rights, but they own 51% of the share of this class of shares? I'm like, well, you just named like every attribute of ownership that there is. So what do they really own? Well, they own the shares. What do the shares represent? Absolutely nothing. So I say, no, that's like, if anyone ever looked at that, they would call that completely illusory, and it's not a bona fide agreement. And I suspect if anyone at the OHA ever saw such an arrangement, they would say, no, that's not ownership. That's something you've concocted that has nothing to do with reality. So what we have done is we construct business deals, but there's a bona fide element to it. Somebody actually has to have the right to receive distributions, the right to vote. There are protections that you can put in place to make sure that a resident doesn't just run roughshod over the rest of the folks. Just like in any company, just because somebody owns 51% doesn't necessarily mean that they make every decision for the business. So my job as attorney in this respect is usually to come up with a business deal where if the OHA ever came back to me and said, I don't know about this business arrangement, is this person really an owner? Just like we talked about having lines of defense with the IRS, I would say, well, yeah, look, this person, this is their contribution, this is the deal. They are really a bona fide owner, and it's not a complete sham. I tell clients there could be no secret side deals that I can be involved with. And usually, though, we do have provisions in there to be upfront about it, that at some point you can sort of buy out the resident when they no longer are necessary. But I had other folks say, well, can we just never give them any money, and when the company 2 years from now we don't need them, can we buy them out for $1? And I say, no, that's sort of, again, to me, doesn't smell and feel like a bona fide arrangement. So I don't have a problem saying, you can buy somebody out in 2025, but I think it would have to be kind of structured as an arm's length, fair market value, customary terms. There's some room there, but you have to come up with something that I think you could defend as this is a bona fide transaction. This is not something we're just doing in a fake way to comply with the residency requirements. And that's it. So sorry, I wasn't too long there, I think. I apologize. That was a little deeper and drier than many of you might have bargained for. But I'm now, I think, Sean, maybe we can move on to the Q&A session, discussion session, whatever you all want to ask or talk about.